The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us right now on Market Talk, I always enjoy having a conversation with David Widmar from Agricultural Economic Insights and catching up on all the different happenings in the markets, the economy, and much more. And it's been a little while since we've been able to have a discussion, so let's bring him in here. David, it is good to hear from you again. Thanks for joining us on the show.
Thanks for having me, Jesse. Always great to connect.
Well, I think since the last time we talked, obviously there's been a lot of things going on in terms of tariffs and trade and the economy and you name it. And I know we have a couple different rabbit holes we can go down here on the show today. I think just for starters, set this up and walk me through some of what you guys are thinking and watching at AEI in terms of this what I'll call fluid trade tariff situation that's impacting the markets and the overall economy right now, David.
Yeah, I think tariffs are one of those things that we've heard a lot about. It's kind of one of those things where we have to be specific about what we're talking about. There are import tariffs, there are export tariffs, there are tariffs we like in this country. Sometimes around protecting ethanol from cheap imports or maybe used cooking oil. Right, we like to see some tariffs on those types of competitors, but it's really the retaliatory tariffs that we're worried about for U.S. ag producers. Consumers are worried about the imports on maybe some of the food or the cars and the goods that we're going to be bringing in this country. So there are a lot of trade-offs, and I think tariffs, and we stepped back and looked at the dollars of tariff revenue collected, and it was a big step up during the first trade war. It didn't go back to pre-trade war levels under the Biden administration. It adjusted as the economy adjusted post-COVID, but we're in a situation where we just have more tariffs going on in the economy. I think the important thing to remember is tariffs change behaviors. And the question is, what behaviors are we trying to change? And so for U.S. agriculture producers, we're really watching retaliatory tariffs. And then what's going to happen for the inputs that we need to import to get our crops planted for 2026. So lots of moving pieces.
Well, I know you recently did some work, and folks can read this in depth on the AEI website. You looked back at the MFP payments that happened during the first trade war, Trump 1.0, and there's been some chatter and rumor that we could see some of those types of payments again with this new iteration of a trade war. I mean, walk us through maybe what you found looking back at some of those payments and some of the chatter that we're seeing here as we move forward on maybe having something similar happen again.
Yeah, it felt like just a few days ago we were living those, but then you have to go back and really dig into the archives to remember what actually those tariffs and those payments were. And one thing I want to point out here is that it wasn't until August of 2018 and 2019 that we actually had July or August, that we had a program that started to take shape and form. Both of those 2018 and 2019 programs sort of had an initial payment that came in August, and then they sprinkled them throughout the fall and into the early next calendar year, depending on how trade was moving forward. There was always some optimism that they wouldn't have to make the rest of those payments because a deal would be struck. Another key difference between the 18 and 19 MFP programs is 18 was based on actual production, so bushels of soybeans produced, while the 19 program had a county weighted average. And so it took all of the pain or the losses that happened for corn and soybeans and wheat and cotton, and it looked at that county production and said, okay, this is the average weighted loss for Crawford County, Kansas, or Tippecanoe County, Indiana, or Perkins County, Nebraska. And the idea there is that way producers could plug in how many acres they planted and they'd get that outcome. They really were trying to avoid a situation where the payments were impacting what producers were planting. So there were some differences, but I think one of the key things to keep in mind is, soybeans saw $1.65 in losses in the first trade war. The second one was closer to $2. The USDA had a way of looking at the loss to export markets, and they were putting a value onto that. So it wasn't maybe true economic losses that producers were facing given all of the factors that were going on, but it was an important estimate. It was a good estimate. I think it's also important to think about last time we had hog payments, we had some dairy payments, we had some specialty crops getting payments. Alfalfa had a payment in the 2019 program. So it's very, very early. We might see an announcement that the USDA is working on a program in the next few months, but it's not going to be till the end of the summer till we can start to put that pen to paper and start thinking about the implications for the farm cash flow.
Now, something I do want to ask you about, a lot of folks have talked about the difference in the overall health of the economy and the ag economy, what it was last time versus now, and it's starkly different is what a lot of people like to kind of frame up and talk about. So from your perspective, how different are things with the overall economy, the ag economy right now? How could that affect what some of this looks like maybe potentially later this year, David?
Very good point, Jesse. I think one of the key differences in the farm economy today is there is a disconnect between the profitability that we're seeing in the livestock sector versus the profitability we're seeing in the crop sector. And so when you look at net farm income, it looks pretty high. But if you take out those payments we received for last year's economic losses, and we also look at it crops versus livestock, there's a big difference there. And so I think the crop producers are in a tough spot to begin with. And then we have the trade war layered on top of that. I think we have conditions weren't great in 18 and 19, but we weren't in 2016, which is that really bleak year in farm income. We're in that sort of bleak area here this time around. So that could maybe increase the need for some ad hoc payments. Now, keep in mind, MFP was sort of the first round of ad hoc programs that we saw, and we've been on this ad hoc treadmill ever since. And so I think everyone's sort of aware of the precedent being set. There's a lot of expectations that these payments are going to continue to come. Every time we say there's not going to be another MFP program in the last 4 or 5 years, there's been something that triggered those. So we'll have to see how that plays out. But I think moving to the broader economy, we have a couple issues. One is inflation. Inflation was an issue in the last few years. It's still, in my opinion, out there and it's lingering. So these tariffs could really kick up inflation in the macro economy. I think we've already seen some data saying Q1 economic activity was sluggish in the US economy. That's going to be another headwind. But I think the third piece here is an attention on the deficit. Deficit spending is sort of in DC's crosshairs, either informally through Doge or formally through the halls of Congress as they think about how they're going to ratchet that down. So that could make it a little bit more difficult for the White House to use the CCC funds or for Congress to pass another ad hoc spending bill.
You bring up a great point, and I'm glad you did, because I did want to get into this a little bit with you. That broader macro economy, GDP contracted a bit in the first quarter. We've seen a slew of data in the last several days, the PCE index, the PMI, jobs data, all these things. You talk about interest rates and, will we see interest rates pull back? It seems the Fed doesn't want to do that, but the president wants the Fed to do that in some ways. I mean, just there is so much out there, and I think a lot of folks are continuing to get concerned about another recession and just the overall macro picture, David.
And I think the challenge with the macro economy is that we're moving a lot of levers in a lot of big directions. Economists are pretty good at thinking about what happens if we move one lever at a time and we keep the magnitudes pretty consistent. So we think about, okay, the economy slowed down, the Fed might lower interest rates in response. But we have all this concern about sort of inflation that's been stubborn. And again, as I said, in the last half of 2024, it was a bit stubborn, more stubborn than the Fed had hoped. And then also we have all this tariff situation. And so I think we're in a very tricky spot here where it's really hard for policymakers, it's really hard for us on the farm making decisions to really think about how do we navigate all of these moving pieces, because we even saw the last few weeks, the exchange rate against the US dollar versus advanced economies, it's dropped a lot. So the dollar's a lot cheaper. And that's going to have consequences and impacts in the farm economy as well. It's just hard to figure out how all of these levers moving at the same time and maybe opposite directions is going to play out.
And I know you wrote about this recently, but the term stagflation, maybe that is what we see here in this overall economic picture, David.
Yes, let's talk about stagflation. Stagflation makes the Fed's job really difficult. And what happens is we have two signals that are conflicting. And one of those signals is high inflation. So that would be a signal for the Fed to raise interest rates. But on the other side, we have high unemployment. And that would be, generally speaking, a signal to the Fed to lower interest rates. So the Fed has to make a decision. Do we let inflation run hot or in, at the hopes of getting more people into the job market, or do we raise interest rates, maybe putting more people on unemployment in an unemployment situation, but also cooling that? And we've seen some fears about it, stagflation. We've written about it a few times in history. It hasn't cleaned itself up, but it could come back. That's what the Fed, I think, spends a lot of time. If you're on the Federal Market Open Committee, that's what you stay awake at night worrying about. The Fed's job the last few years, they had to fight some pretty significant inflation, but we had a very tight job market. And so we didn't have to worry about the economy being in a recession and exacerbating it by raising interest rates.
We're talking with David Widmar from Agricultural Economic Insights here today on Market Talk. And David, something else I want to talk to you about is the acreage debate. And I know you guys doing work on this again this year. You've been doing work on this for the last several years. As we get into the spring planting season time frame, we're working through the heart of it right now. Obviously, everyone likes to talk about how many acres of corn, soybeans, wheat, cotton, etc. are we planting in the U.S. And I think this year especially, it's an interesting dynamic. There's a lot been made about we're going to see a lot of corn acres, input costs are high, things of that nature. So what are you hearing from producers? What are you tracking in terms of that acreage debate right now?
Yeah, I think one of the things that we can sort of be thankful for is that we had some economic signals for the last 6 to 10 months telling us plant fewer soybeans, plant more corn. I think that is shaping up to be a good strategy in light of that trade war. So that's going to be one of those stories that kind of gets swept under the rug, but it is going to be relevant for the rest of this year. One of the things that we help our clients think about is not only what those national acres are going to look like, but where they're going to unfold. And 95 million sounds like a big number, but given that price ratio, it wasn't completely out of the realm of possibilities. But we planted about 95 million acres of corn just 2 years ago, 94.8 versus 95.2. So it was a similar comparison. One of the things that we're helping folks think about is that between those 2 years, 2023, 2025, corn has shifted more to the west, and we're seeing less corn acres in the eastern parts of the corn belt. And then soybeans have mostly moved into the eastern corn belt, and we're seeing a drop in soybean acres in the western corn belt or in the Great Plains. So this idea here is even though we're planting the same number of acres in the country, 2 years apart, we've shifted those acres to a pretty big degree at some of these state and then eventually county levels if you follow the data down there far enough. I think the other thing that's really different here is we have seen cotton acres fall. So you think about that Delta region in towards the south, and you see an increase in corn acres, but not a decrease in cotton acres because they're trying to offset, of course, fewer cotton acres in that area. So we'll have to see how that plays out. But again, I think if you're a grain buyer, if you're a producer and you're in the Great Plains, you got to be cognizant that there's going to be a lot more corn out there than there was, last year and even 2 years ago. If you're in the East, it's the story about more soybeans, and that could have an impact on those local bases.
And you brought up, cotton acres, for instance, and this is something we've talked about for the last several years in varying degrees is what those quote unquote fringe acres will look like for corn and soybeans. And do we see, cotton come out of production or sorghum or spring wheat, for instance, up north or canola, all these different things. And, just with the way some of those input costs are compared to what the markets look like, whether it's futures or cash, it continues to be a debate that really rages on here, and it has for several years, right, David?
Yeah, I think sometimes we look at these returns for corn and soybeans, and we're like, hey, there really isn't a great prospect for either of these. Clearly, corn this year had a better position, but neither one of them was in a positive economic cost situation. But we always have to think about wheat. Winter wheat is a really big one, especially 5 years ago. We were talking about 2016, 17, 18 earlier. We kept planting more corn and soybeans in the Great Plains because winter wheat has such a bleak outlook. And so now we're thinking about cotton and even spring wheat. Those acres are are pushing their excess production, their excess acres into the corn and soybeans, which would frankly be happier not having as much production, right? We like to see, if you're hoping for higher corn and soybean prices, you like to see fewer acres, but these fringe crops keep pushing those low prices, those low economics into corn and soybean production. And I think that's always a head scratcher, especially if you're thinking about acreages. We can think about how big the pie is, and then we can think about the slices. How big the pie is going to be is always a big question mark because of those fringe acres and how they're going to move in and out of corn and soybean production.
David, talk about this for us as well. You guys have done this last several years, the Ag Forecast Network, the Yield Forecast Challenge back for 2025. And that's a cool thing that you guys have done for a while now. Tell folks about it if they're not aware.
Yeah, we like to challenge folks to think about uncertainty. And there's not a lot of tools, or we don't get taught a lot of lessons about how to think about uncertainty in a good way. But we frame questions and a probability, like a weather forecast. So what's the probability of this WASD report having this yield estimate above or below? And so it's a great way for followers and producers and subscribers to look at where their expectations are, challenge their thinking, update them based on other information you get throughout the year, and also benchmark yourself so you can see what your expectations are versus everybody else. And as my business partner always says, if I'm a long way away from that consensus, I need to update my thinking. Sometimes I could be right, but usually I'm missing a key element of that. So there's 16 questions. 2 of those opened here this week, and they're going to go all the way through November. And they're thinking about what's the prospect of a corn and soybean yield that's above that trend line or above that trend normal expectation. And then the other questions update after every WASD report to help us think about, are we going to go higher or lower from here? So again, it's a great way to kind of challenge your thinking, get really specific about, what's going to be relevant to the markets and what's not relevant. And it also helps you tune out some of that noise.
David, great conversation as always. Final thoughts you would mention to folks or reiterate here today on the show?
I wish everyone successful 2025. I know it's stressful, but keep in mind, enjoy that time you get with your family, enjoy that downtime. And I think the other thing to keep in mind is that we want to look for strategies that create flexibility and options for us down the road. So whether it's your marketing plan or your capital purchases, or it's your farm growth plans, you want to make sure, given all the uncertainty out there, that we prioritize strategies that give us future flexibility. And that's really going to be key for navigating 2025 and I think also the next few years.
You guys have a lot of great content as well on the AEI website. Give us a plug for that real quick, David.
Yeah, AEI.ag. You can always check out our free Monday newsletter and get access to our weekly insight article. But then there's also the option to subscribe, as we mentioned earlier, that Ag Forecast Network tool. And we have a lot of great data and content behind the paywall as well.
AEI.ag for more. David Widmar, Agricultural Economic Insights. Always good to hear from you, sir. Have a great week, and we will talk to you again real soon. Appreciate it.
Thank you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.